Okay, good. I think, shall we get going? Thank you very much, everyone, for logging on and for your interest this evening. I've got my colleague Andrew Vintcent also on the line, and we've got really three key objectives which we'd like to get across to you this evening as investors in the ClucasGray Equity Fund and Equilibrium Fund. And those three objectives are really to give you a good picture on the positioning of both funds. Secondly, why are we positioned as we are within each? And then thirdly, to give you an update on the performance of both of the funds. Our intention is to present for around about 40 minutes and then to really leave as much time as you would like for Q&A. So I'll kick off, and then Andrew will take over when we get to the relevant points on the equity fund, and I'll cover the Equilibrium Fund. Very briefly, just an update on ClucasGray and the business, and just want to highlight 2 points towards the bottom of the slide. One is that we are now at a size where we have 15 investment professionals analyzing various assets and asset classes, which is just such a key ingredient to the running of funds such as the ones that we're going to be talking to this evening. So that all feeds into what we call a common research and investment platform, which is used to implement investment ideas in these two funds. Some background on each of the funds. Andrew and I have been running these two funds together for the last 10 years. The equity fund, just to make 2 points on it, sits at just over 1.6 billion rand at the moment. And this is a South Africa only equity fund. It does not have offshore investments, and its focus is on JSE listed South African equities. On the right-hand side, you'll see just a snapshot of the Equilibrium Fund. 2 points to make here. This is a Regulation 28 compliant fund, so suitable for retirement annuities, pension fund type investments. And the key objective of this fund, which we'll go into in some detail, is we have an objective of trying to deliver inflation plus 4% in this fund over time. A cornerstone of our investment process, which we'll refer to later on in the presentation, is what we call our alpha thesis. And our alpha thesis really presides on two key drivers of a share price or an investment. That is, we look for real growth in earnings, dividends, and cash flows. Secondly, we try to look for a change in the rating or the PE multiple of any investment which we go into over time. And we'll refer back to this, but this is something that we really believe is important in trying to generate real returns for our investors. We're going to give you just some very high level a very high-level overview of the global macro and the South African macro environment, and then we'll go straight into the specific positioning of the two funds. Our overriding assumption on global growth is that we think it's going to be moderating in 2025. The chart on the bottom left shows you that long-term trend growth for global growth sits at around about 3%. We expect that to be lower during the course of 2025, primarily driven by dampening demand because of the effects of tariffs around the world. You will see that there is an expected pickup into 2026 and beyond, where 2026 there is an expectation that growth returns back to longer-term trends. We do, however, think that there are some supporting factors that could come through later on in the year, one of which is interest rate cuts in the US. Secondly, there has been talk of, and there may be tax rate cuts that come through in the USA as well. So we do think that there are some supporting factors for growth into 2026 and 2027. Just moving on to some of the macro assumptions for South Africa. You'll see in that table on the right-hand side there, expectations for GDP are very modest in 2025, under 1%, but improving into 2026 and 2027, where we think that the effects of gross fixed capital formation are going to come into effect, where we think that there's been a real backlog in fixed capital formation over a number of years. You can see that in the chart on the bottom left-hand side, as well as the ancillary benefits of the privatization of certain areas of infrastructure development, such as the rail services, which has been announced in recent weeks. And we think that that should pick up, allowing gross fixed capital formation to grow at a much faster pace than GDP. What we should also recall is that that GDP number that you see there is a real number. In other words, if we add inflation to that number, we could well find ourselves growing in nominal terms in South Africa at somewhere between 6 and 7% into 2026 and 2027. And that's important because it allows companies' top line, their revenue, to grow at a better pace than what you see in the 1 to 2% levels in the GDP number. What we also think is that inflation is fairly well contained within South Africa and is likely to be in and around 4% over the coming years. And we do anticipate 2 interest rate cuts at least in the coming months of 25 basis points and another one making the total cut 50 basis points over the next 3 to 6 months. I'm now going to hand over to Andrew, who's going to take this down to an equity level and take us through the equity fund. Thank you.
Thanks very much, Grant, and good evening again, everyone. Thank you for joining us. I think it's fair to say that the last decade an example of the 2 extremes of the last decade will be the performance of the S&P 500 from 2015 to 2025. And as Grant has alluded to, the very frustrating performance of the South African economy. So what we try to do to illustrate this, the disparity between these 2 economies is show you the breakup of the return of the S&P and countering that, the total return makeup of the JSE Banks Index. And we use banks because they're a good proxy for us, for the local economy. They've got lots of data, and it enables us to go back in history and to assess how they've performed. So if you look at the bull market in the US equities for the last 10 years, when we look at the makeup of a return, there are 3 key components. You get the earnings growth, you get the dividend yield, and you get the change in PE rating, where the PE goes from 10 to 12, share prices go up 20% hypothetically. So if you look at the S&P over the last decade, they've had a very strong economy. The US economy has been a standout. Earnings growth of the S&P has been around 8% per annum for a decade. The dividend yield is relatively paltry compared to what we get in South Africa because it's just the nature of the US markets. Their dividend yield has been 2%. And the rating that they've enjoyed in this bull market has seen that the PE multiples expand by effectively 3 to 4% per annum, which gets you the 14% dollarized return from the S&P 500 over the last 10 years. A remarkable period for equity investors. But let's bring it back home. In the face of a very tough economy, as we're all aware, and we've had the numerous crises with which we've had to deal with in the last 10 years, starting in 2015 with the famous Nenny Gates. We've obviously had the COVID crisis. We've had some geopolitical issues, and our foreign policy has been questionable at times. We had the issues of the Russian ship at Simonstown. And then we had the build-up to the election. So we've had a litany of issues that we've had to grapple with in the South African economy. Yet, notwithstanding all of that, our banks in rands managed to grow their earnings again by 8 or 9% per annum. Because valuations are generally more attractive in South African equity markets, the dividend yields of the banks have been in the order of 5% over the last decade. So the combination of those 2 looks very similar to the potential return you would have got on the S&P of 13 or 14%. The difference being we have endured a headwind of a derating. So the chart on the right shows you that the bank PEs in green have gone from an index level of 100, and they derated by 30% over the course of the last decade. And completely countering that, almost the mirror image of that has been the blue line, which is the S&P, which also started, we indexed to 100, and that's risen by 40% over the course of the last decade. And that is ultimately a depiction of what has played out over the last 10 years. So where do we sit today? If you look at a sample of companies, we've taken 6 companies in the next slide. They're disparate. They're 2 banks, they're 2 retailers, and they're 2 industrial companies. And the only commonality between these 6 is that they have hardly changed in the last 20 years. They've largely stayed the same. They haven't ventured offshore in any meaningful way. They haven't required other businesses to change their income stream. So largely speaking, for the last 2 decades, they have remained pretty similar. So using an average PE multiple of these 6 companies, we think is a depiction of the journey that South African investors have been on. And you can see the 2 troughs of the PE multiples were during the global financial crisis of 2008 and 9, when world markets were very, very weak, and the COVID crisis of 2020, when, again, with fresh in the memories of many, was when markets got completely sold off. Outside of those 2 crises, which were global in nature, the derating of domestic assets is stark. You can see today, if you go back to the uncertain periods of them before the 2024 elections in April, May of 2024, South African assets were effectively on a fire sale, and you can see how low PE multiples got in that period. Yet here we stand today, and the valuations of these 6 and many others are effectively cheaper than they were before the elections and not far off where they were in those 2 global crises. So it's been a very interesting bull market. You've had some large cap companies that have run very hard, and we'll show you later, equity returns have been very good. But in the midst of that, you've had the significant derating of domestic assets. And that is an interesting opportunity, which we'll try and explore over the course of the next few slides. So if we look at the next one, it shows you, hopefully, companies that are familiar to many of you or most of you, some large cap domestic companies, some global companies. And what we show you is the period from October 2024 to the end of last month. It was a period when equity markets have done quite well. And remarkably, despite the doom and gloom we read about, earnings growth had been reasonably solid for many of these companies. But what to us is astounding is that you end up with a position where valuations on many, and if we run down the list, Absa, Standard Bank, Motus, Momentum Mutual, Reunert, the Cal Group, the commonality between these businesses is that they are very much focused on South Africa. You've had some standouts that have done particularly well, most notably British American Tobacco, and some of the resource counters. But largely speaking, you're getting good businesses at what we think are historically attractive prices. So if you cast your eye down the right-hand column of August 2025, you can see PE multiples forward of 5s and 6s and 7s. Bellwether businesses that have proven themselves over many decades, including the likes of Bidvest, which is trading at a rating which is, quite frankly, unheard of in the context of Bidvest's history. And then if you look at the dividend yields, and considering how important dividends are in the total return makeup of any investment, you're seeing dividend yields here of 4s and 5s, 6s, and even in some cases nearly 9%. So we think that is the landscape that we as investors have been presented, and it does look reasonably attractive. So what have we done in the equity fund? And when we talk equity fund here, Grant's going to finish up, as he said, on the ClucasGray Equilibrium Fund, and the equity carve-out that we talk to forms the equity components effectively of the Equilibrium Fund. So whatever we say here is relevant to the discussion a little bit later. So the current positioning, we maybe start off at the bottom of those 3 blocks. we have a portfolio construction philosophy. We won't own more than 30 shares. We believe in focused portfolios. It does mean that when we want to add a new investment, one has to then make space for it by making decisions, and tough decisions sometimes between different companies. We want to have a minimum weighting of 1.5%. We just think that if you have any less than that, it's no point. You do all the work on a company and you get it right, but if you've got a 0.5% weighting, it doesn't really make a material difference to the overall portfolio. And we want to have a maximum weighting on the right-hand side of 10%. And that would include, in our minds, the likes of an Aspas and a Process combined, because ultimately they are linked to the performance of one company, which is Tencent in China. So those are the parameters around which you operate. The portfolio we've constructed has a weighted PE multiple of 9 times. That includes some companies which are well priced, and many of the ones we've just shown you which are very attractively priced. The weighted dividend yield of the portfolio of 5%, and both of the PE multiple and the dividend yield compare extremely favorably to the overall JSE market. So if you look at the slide on the numbers on the left, the top 15 shares, I think we'd like to stress what is, to us, very important. Grant would have alluded to in the beginning, this ability we have to take advantage of a wide array of opportunities. We're not a large asset manager. We've got a large team, which Grant spoke to, and we invest in we research a wide number of companies across the market cap spectrum, but we want to take advantage of those opportunities as they present themselves. So in the top 15 shares, you will see the likes of Motus, which is a medium cap company, the old Imperial Group motor business. Reunert, which is a mid cap. Astral, which straddles between a small cap and a mid cap. The Rainnet Group, the Cal Group, Life Healthcare, and Fashini. So you get a whole range of differentiated offerings that feature quite prominently in the top 15. What you won't see in the top 15, which you may have seen a year ago if you were on similar calls, would be the likes of British American Tobacco, which has been an extremely good performer over the course of the last 6 months. Likewise with an MTN, which really off its very sold off levels has almost doubled over the course of the last 6 to 9 months. And we would have taken some profits in those particular holdings and reduced the weighting so that we may still own them, but they're outside of the top 15. So that's the makeup of the portfolio we've constructed. I think the next slide will talk in some way to some of the changes we have made. I alluded to the fact that we constrain ourselves in terms of how many holdings we have. We were positioned in a company called Adcock. Adcock is majority owned by Bidvest, but it has a 30% of Adcock was listed. In the last month or two, a foreign pharmaceutical company has come in and bought out the minority shareholders. So it'll be owned now by Bidvest and the new buyer, and it'll be delisted. Our portfolios were positioned in Adcock, so that we have taken a decision to sell and to exit and to redeploy that into other names. MTN and British American Tobacco I alluded to. Anglo, similarly, when Anglo spun out their Valterra stake, which is the Anglo-American Platinum stake, the weighting dropped, and we've ended up with holding both Anglos and Valterra, and we'll get onto the Platinum theme in a second. And then Impala has run very hard, and Naspers Process have run very hard. So we just trimmed some of those weightings. And what have we increased our weightings to? The list of companies is there. I think the commonality again is, we'll show you in the next slide. We'll show you how we think that these opportunities have presented themselves. And we're going to go through some segmentation of the portfolio in a second. The final point to make is that given that companies are so inexpensive, what normally happens in this cycle of a listed investment is that as businesses get too cheap, or the prospects for them to re-rate do not look obvious, what you find is private capital may come and look for ways to extract that value. And you have these effectively takeouts. We've alluded to Adcock in the left-hand column. There are two businesses that are under caution. One is Ethos and one is Metrofile. We don't know where it all ends up, but there are moves afoot, we think, to try and unlock some value. So hopefully those end up constructively and that shareholders get to benefit from an increase in the share prices. Maybe one more slide on the segmentation of the portfolio. It's a portfolio of 29 shares with a wide array of market cap opportunities. You can see the JSE has 90% of its constituents have a market cap of over 30 billion. In the portfolio, only 65% of our portfolio companies have a market cap over 30 billion, which means we are playing in the mid and small cap space to an extent of the portfolio. The portfolio is liquid. We're comfortable with the liquidity metrics within the portfolio in terms of being able to sell shares if we have to. But we just think it's appropriate for us to take advantage of what we think is quite a unique set of circumstances, in that you've had this dislocation between these large companies and some of the medium and smaller companies. So you can see 30% of the portfolio, over 30% of the portfolio has a market cap of less than 30 billion. What is interesting about the companies on the left is, firstly, I don't think there are many other equity funds that have an exposure to such a differentiated range of companies. They are in many ways unified in their attractive valuations. And in many instances, these companies have taken it upon themselves to try and extract the value that they believe they have. So the case of Life Healthcare, they've sold an international business, they've utilized the cash, they're paying special dividends and doing buybacks where possible. Ethos, I've alluded to, they are selling all their underlying investments and handing back the proceeds to investors. Metrofile's under cautionary. The Astral Group I'll talk to in a second. ACI is one of the oldest listed companies in the country. It has struggled enormously with a very suppressed valuation multiple. It's taken some tough decisions to sell some of its underperforming businesses, get back to its core, its roots, and using the proceeds of those asset disposals to either buy back shares or to focus more acutely on their core businesses. Savage Capital have been buying back shares. It's a holding company that trades at a material discount to its NAV. It's been buying back its shares. And the list goes on. We could make an example of each of these companies. And I think that is instructive of where we find ourselves in the life cycle of a listed investment. When businesses get expensive, companies use the listed environment to issue shares at a very expensive rating, to use that capital and to make growth acquisitions. And conversely, where we are in the cycle right now, when companies are just too cheap, effectively the listing mechanism is defunct. And as a result, they've got to find ways to unlock the value that they believe, and we happen to share their belief, exists within those companies. So we go to the next slide. What we try to do, and I won't spend too much time on this, I think we try to break down the portfolio into these 5 key elements that we look at. We look for, ultimately, we all want to buy the perfect business, which is going to grow its earnings structurally over time, but we want to pay the right price. We've highlighted a few that we think fit that criteria. Attractive real growth in a tough economy. Ultimately, all you can hope for is those businesses that just grow a little bit faster than inflation. They trade at a good multiple, they pay back good dividends, and all of these companies would fit that bill. I think the one area I'd like to just spend a minute on is the cyclical side of things. The cyclical companies, the mining companies are, as an example, are difficult to call because, when the cycle's in their favor, the earnings growth is significant. But obviously that's by nature that the term cyclical is relevant. So if I look at some of the domestic cyclicals as an example, we think it's very interesting. The likes of an Astral, they're a chicken producer. Their input costs are a commodity, which is often the likes of maize or soya. And when those commodity prices fall and they can hold their chicken sale prices, they make a margin on lower feed costs and higher sell prices, and you get a margin expansion. Similarly, the likes of a Motus sells motor cars. They do lots of things around the motor vehicle value chain, but if you just think about the sale of motor cars, new and used, life is easier when interest rates are lower and there's more activity in that space. So with interest rates being slightly reduced, with the difficult economy we're coming out of, with the prospects that Grant alluded to of GDFI growth and potential employment growth, lower interest rates, adding to all of that, we think that the outlook for some of those parts of their business are pretty constructive. And then the various cyclical mining companies that we do own, we think, particularly in the case of platinum and in the case of copper, that the supply-demand fundamentals are very strong. So some of those businesses we have been adding to, and admittedly, many of them have run very hard in the last while. So there's some unique opportunities that we think have served investors well and have the potential to continue to do so. So I think that's probably it in terms of how we segment the portfolio. We can spend time. Maybe we can pause for questions on that particular slide, Grant, at the end. So what does it all mean from an equity return point of view? If you look at these three key components, and apologies, we've cut out the bottom, the axis in the bottom doesn't show the re-rating chart, which is the green block. But we've got earnings growth. We think of the portfolio of companies that we've put together in the order of 8 to 9%. Steady, if unspectacular. We've got a dividend yield I showed you earlier, which we think is going to be in the order of 5%. And the combination of those two already give you a reasonably good return. And now, with the way we illustrated the de-rating that these businesses have experienced over the last number of years, we think that the potential for ratings to be a tailwind to investments as opposed to a headwind like they have been is very, very much a theme that we think could play out. So the combination of these three, we believe, has the ability to deliver what we would deem to be very acceptable returns on the domestic equity portfolio that we've managed to construct. So if you then roll forward into performance, what does this mean? I think that the last 5 years, or the last 1 year, the last 3 years and 5 years have been pleasing from a performance point of view. You can see the last 12 months, portfolio is up just over 20%, and the last 5 years up over 22%. I think what's in equity investors in South Africa have finally enjoyed after enduring a very tough period of modest returns is finally getting very strong real returns. You can see real returns at the bottom are very attractive, with real returns over 5 years of 17%, 11% over the last 3 years. And even going back in time, the 14 years since this fund was inception, real returns of nearly 8%. And we think it's been an encouraging performance. And the irony, or the strange part of this whole discussion, is that notwithstanding that the returns have been as good as they are, we fundamentally believe that the slides we showed you earlier point to the prospects for further good returns from some of these opportunities that we've identified. What we must state is that we are active managers. I think if you look through the top 15 shares, you realize there's some very big names that don't feature, certain key sectors and certain key companies. But what we try and show is, because we're different, we believe in trying to outperform the market over time. But because we're different, we can't outperform the market all the time. And you go through these periods where you may lag the overall index. And you can see in 2020, in the COVID crisis, we lagged. We came out of that period by sticking to the process that Grant pointed to in the beginning of the presentation, sticking to the process, identifying opportunities, and investing with conviction. We came out very strongly. And then what we've had in the last 8 months, even though the funds are up, the equity funds up over 15% in the last 8 months, year to date, what we've had is it's lagged the index. But the point is that over time, we believe it's a strategy that works. You go through this period where when liquid shares run, some of the smaller and medium cap shares may lag behind, but they catch up when value unlock strategies start to come through, or companies deliver on the earnings that we expect them to deliver. So it is the nature of being an active manager. You go through these periods where you underperform and outperform, but over time, our quest for alpha has been demonstrated by the performance of the portfolios over time.
Thank you, Andrew. I'm now going to just move on to the Equilibrium Fund, the positioning and the performance of that fund. And just to, as a reminder, our overall objective in this fund is to deliver returns, real returns of 4%. And what we do is try to look at the investment landscape, all asset classes, and to try to position the fund where we think we have the best chance and best opportunity of earning inflation plus 4%. That is the horizontal blue line that you see there. And what you'll note is that the green Manhattan bars are domestic assets, so domestic bonds, domestic equities, banks, you'll see on the extreme right-hand side. And and that the golden colored Manhattan bars are primarily foreign assets. In hard currency returns, we think that foreign assets are likely to generate a more modest return. You can then add or subtract the movement of the rand to that return. But the point of this chart is to demonstrate to you that we have positioned the portfolio primarily in domestic facing assets, and particularly in the cash and fixed interest space in domestic fixed assets and cash, because we think that those will yield much better returns than the foreign alternatives. What that means in the context of the current positioning of the balanced fund is that we have 56% in South African equities as at the end of August. What I would say about that is that there are 3 investments within there, which Andrew mentioned, which we think are enhanced cash positions. They would be Adcock Ingram, Life Healthcare, which is paying a huge special dividend next week, and then Raynet Investments, which is a near cash investment in its current form. And that cash is predominantly invested in euros. Listed property makes up 4% of the fund, fixed income 23%. We'll give you more detail on that in a minute. And then the foreign component adds up to about 17%, 15% in equities and 2% in income. Why are we still optimistic on the returns from South African bonds and South African fixed interest investments? Our base case, highlighted in blue on this left-hand table, is for South African bonds to give us a return in the order of 10 to 11%. We still see the opportunity, given the high yield and starting point, for bonds to deliver attractive real yields. They're on a starting real yield of 6%. And so we think that when you're on a starting yield of 9.5 to 9.6%, you don't have to have much compression in the bond curve to get you to a return of 10 to 11%. What is worth highlighting here in this bottom left-hand box highlighted in green is that the fixed income component of the Equilibrium Fund is currently on a yield of 9.5% with a duration of 5.2 years. But to have 23% of the fund giving us a running income and running return of 9.5%, we think is a comfortable starting point. Just moving on to the global allocation. The global allocation is primarily in equities. Most of the non-equity component we hold in domestic bonds, as I alluded to. We do have a small position in a corporate US dollar bond, as well as a very small position in US Treasury notes between 1 to 3 years of duration. We felt that we wanted to give you some more detail on the underlying global equity exposure of the fund. And what we highlight here on the left-hand side is that the largest single exposure is to a US fund manager called Dodge & Cox. We'll give you some additional details over Leaf. That makes up 6% of the fund. Veritas, which is an asset manager based in the UK, that occupies 5.3% of the fund. And then we own an iShares Europe 50 ETF, as well as a manager in Japan called Arcus. What that means from a regional perspective on the right-hand side, you'll see there is that we have 38% of the fund's global equities in the US, followed by the next largest position, which is in Europe. 30% of the fund is exposed to Europe, and then another 14% exposed to Japan. We'll explain it in more detail, but we think that the opportunity in Japan is both from a currency perspective as well as an underlying equity perspective. The one issue which is occupying our minds is the dollar. You would have seen that the dollar has depreciated by around about 9.5% for the year to date, having been strong and dominant for the better part of the last 12 to 15 years. The chart in the middle just highlights that emerging markets have generally tended to struggle to perform in an environment of a strong dollar. So the chart in the middle shows you the dollar index, which is in red, and that is inverted. And the blue shows you emerging markets performance versus the S&P 500. And so a strong dollar environment has generally been more favorable for S&P and US asset performance. When the dollar weakens slightly, it has tended to be better for emerging market assets. One of the reasons why we have tilted the portfolio into a manager like Dodge and Cox is that they are quite well exposed to some components of emerging markets. The other chart on the right is fascinating. We think that the Rand has had a difficult time. The Rand has actually been incredibly calm compared to currencies like the yen, which have depreciated enormously over the last 3 years against the dollar. And we think that some of this may begin to normalize in the months and years ahead. The yen was at an index level of around about 115 at the end of 2022, and that's sitting just short of 150 as things stand today. This chart just shows you the relative outperformance or underperformance of international assets, and so you should read international equities other than US equities during periods of a declining dollar or periods of an appreciating dollar. We've dealt with a strong dollar basically since the global financial crisis, 2008 and 9, and the dollar has been strong, and US assets have outperformed international assets over an extended period of time. The gray shaded bar here shows you a period where the dollar was weaker relative to other currencies. And what you can see is that you had a period of international assets outperforming US dollar as equities over that period of time. We're not saying that this is going to happen with certainty, but we see some signs that international assets are beginning to outperform, and hence we have some positioning in the portfolio accordingly. Just some snapshots on US and international equity market ratings. The chart on the right shows you the valuation levels of the S&P 500, which currently sits on a forward PE of 22 times as at the end of August. You can see that the 30-year average for this index is 17 times, so we are trading on quite a premium to where we've been over the last 30 years. What we do know, it's been in the headlines of most financial press, is that this performance and this rating has really been driven by a very narrow set of companies. The top 10 in the S&P 500 has really driven the majority of the returns. Those top 10 are trading on a PE multiple and rating of just under 30 times. The remaining 490 stocks are trading on a multiple of 20 times. What this does mean to us is that there are certainly opportunities away from some of these higher valued stocks, which fund managers are likely to seek out. What we do think one should be less pessimistic about is that despite the high ratings, there's certainly support at an earnings level for dollar companies, dollar earning companies, where the weakness of the dollar we think could boost S&P 500 earnings by somewhere between 4 and 5%. We also think that there's going to be some benefit to earnings for companies when interest rates eventually do get cut by the Fed. So certainly we see some tailwinds for earnings in US-orientated companies. Just moving on to some of the global ratings, what you'll see in this table on the left-hand side is what we alluded to earlier, that US ratings, highlighted by the diamonds, are trading at levels above their long-term average, which is that horizontal gray bar. Whereas in other regions like Japan, like Europe, and emerging markets, ratings are far closer to longer-term multiples than they are in a region like the US. Similarly, if you have to look at investment styles, something like value versus growth, you will see that value-orientated businesses are now trading at a significant discount to growth, around about a 40% discount, whereas the long-term average is 30%. All this means to us is that we are trying to position the global equity component of the Equilibrium Fund into assets which are looking more attractively valued and redeploying capital out of assets which have run very hard. I said that I would give you a little bit of additional detail on Dodge & Cox, which is the single largest piece of global exposure in the fund. This is a US-based manager. The size of this fund is $6.3 billion, and we hold around about a 6% weighting. What you'll see here is its value orientation. The portfolio has a portfolio metrics of 12.8 times as a forward PE ratio versus the All Country World Index, which is 19 times. So what they have done, which you'll see in the pie chart on the right, is tilted the portfolio in favor of assets which they think are more favorably priced. Developed Europe is 17% of the fund, emerging markets are 16% of the fund, and the UK is 9%. The US still occupies 47% of the holdings, but it's significantly different to the World Index, which is closer to 2/3. We've given you here a best guess estimate on what we think the prospective returns for the fund could be in the 12 months ahead. What we do know about this estimate is that we will be wrong. What we hope is that we will be wrong to the upside and not the downside. But what we've provided here is just an estimate on the current positioning of the fund, so 55% in domestic equities. If we get a return of 16%, the weighted contribution to the fund would be 8.8%. And you'll see the other allocations to the specific asset classes, and our overall estimate is in and around 12 to 13%. We certainly think that that the fund is capable of delivering that return, and as an ancillary point, what we've highlighted here is just the income yield which we think we're getting from the underlying asset classes within the fund. So if you had to put 100 Rand of investments into the current asset classes as we've depicted here, how much income are you likely to earn from each of those asset classes? And what you'll see on the bottom right-hand side is we think we're getting an income contribution from these assets of 5.8% alone. What that means is that even if we get a fairly limited capital contribution of 6 to 7%, we still think that we can derive low double-digit returns as an overall performance. To put that performance into perspective, we've just given you a history here over the last 10 years and since inception. The fund has delivered just over 15% in the last 12 months to the end of August. That is in line with the peer group, but more importantly, is a real return of around about 11.7%. The returns over the last 3 years have been 14.5% compound, and over the last 5 years, just under 16%. And what that obviously translates into is that unit holders and investors over the last 5 years would have doubled their money within the fund. Andrew alluded to it earlier, but the last 5 years have been far more pleasing than the 5 years prior to that, where the returns, if you split up that 10-year period, the first 5 years were hard going. The last 5 years have delivered returns which have meant that patient investors, have been rewarded with returns more commensurate with taking this level of risk. What I alluded to in the beginning is that we set ourselves an objective of generating returns of CPI plus 4%. Pleasingly, since inception, around about 11 years ago, inflation of 4.9% has been the measured inflation. That translates into just on 9% of inflation plus 4%, and the fund has managed to generate over 10. It's certainly our intention to endeavour to generate CPI plus 4% going forward. I'm going to wrap up on one final slide just with regards to our summary view and investment implications, and then open up to Q&A. Our overall sense is that tariffs are a net negative for growth. We think that there are currently too many unknowns to be too prescriptive about that and to gauge the full potential of it. But as we showed earlier, we do think that it is likely that growth estimates are going to come down, but we don't see a recession. That is not our base case. South African growth estimates are very modest for 2025, but they do pick up into 2026 through 2028. And globally, we see a situation where inflation dynamics could initially rise because of tariffs, but then likely subside because of lower demand. That's our best guess as it stands at the moment. I'm completely stating the obvious, but it goes without saying that geopolitical risks and tensions are as substantial as we can recall in managing these funds over the last 11 years together. But it is very difficult to position a fund for geopolitical outcomes. The investment implications to our minds are that valuations in the US are very, very fully priced at an index level. Markets have recovered so strongly from the levels that they hit in April earlier this year. But certainly the geographic and sector dislocations and dispersions are very significant, and that provides opportunities for maneuverable managers to find investment returns. On the positive side, we think that various stimulus measures are still on hand and likely to come in the months ahead. Most importantly, rate cuts in the US. We've already seen that materialize in Europe, but we think that the US will commence with rate cuts. Tax cuts have been promised. Let's see if those get delivered. But those are two supporting factors, we think, for equities and for US bonds. Energy prices, important to note, are at levels which have historically been quite supportive for economies. So an oil price between $60 and $70 a barrel with low gas prices is a pretty helpful outcome for many economies. SA domestic valuations we've highlighted as being very cheap and attractive, and hence we have positioned these two funds to try and take advantage of that. I'm going to stop now and open up to Q&A, and at the outset, just thank you all for your time. Happy to take any questions on voice or in the chat if you like.
Hi, Grant. Joshka, how are you doing?
Hello, Joshka. I'm well, thanks. And you?
Good, thanks. Sorry, just on fresh speculations regarding sanctions and grey listings that we're currently facing, that our SWIFT systems are being used as a new means of sanctions for our banking sectors. Is there any insight to that?
I think it's something that we have to monitor closely. The issue around SWIFT specifically, Joshka, we think is a little bit more complicated in that it is an organization of most of the G10 central banks. And so one nation in the form of US, we think will find it difficult to switch off SWIFT messaging for a specific country without the others agreeing. The other important point to note about SWIFT messaging is that it's a critical element to the track and tracing of money laundering elements. And if you do away with it, you're simply exacerbating a problem between other countries. So we see the headlines, we take note of it. I don't think we should be flippant about it, but we think that the likelihood of an action like that proceeding is fairly limited at this point in time. The other point and question which you ask around, sanctions and other geopolitical elements. I think the reality is that we need to wake up in as a country in the form of geopolitical issues. We've got to align ourselves more on commercial lines, trade lines, commercial lines, as opposed to old political allegiances. And as soon as that happens, we think the landscape could become a bit more encouraging.
Thank you very much. Appreciate it.
What I would say, if there are no further questions right at this moment, is that Andrew and I would both be very happy to take any follow-up questions and direct questions on email, as you may wish, if something comes to mind thereafter. But if there are no further questions, then just remains for me to say thank you very much for your attendance and indeed for being investors in these two funds. Thank you very much.
Thank you very much, Grant, and thank you all for joining us this evening. Please do get in touch if there are any follow-up questions.
Thanks very much,
Enjoy your
everyone.
evening.
Have a good evening. Bye.